Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Opendoor.
If you find our talks useful, please consider subscribe, like, and comment underneath. I want you to imagine waking up to find a stock in your portfolio is up like over 340% in just a couple of months. You'd probably double check your screen, right? Just assuming it's a glitch.
Oh, absolutely. I mean, you'd think your brokerage app was broken.
Right. But then imagine a prominent hedge fund manager looking at that exact same stock, the one that's already up 340%, and saying, actually, it has another 1,500% to go.
Which, sounds completely untethered from reality. Like, totally absurd until you actually start digging into the underlying math.
Yeah, exactly. And the company we are talking about here is Opendoor, mapping out how a business gets slapped with a 540% upside target for 2028. I mean, that means figuring out if Wall Street is looking at a genuine, operational revolution, or if it's just a masterclass in market hype.
And that is exactly our mission today. Because let's be honest, Opendoor was written off by almost everyone a couple of years ago. It was left for dead.
Totally. So to understand this massive 340% rally since January of 2026, we really have to isolate the immediate catalyst. And that was in late February, they dropped a Q4 2025 earnings report that just fundamentally reset the entire narrative.
Yeah, it was a massive shockwave. The street expected them to bring in, I think, about $596.4 million in revenue for the quarter. And Opendoor, they posted $736 million.
Wow, wait, $736 million?
Yep.
So that's a $140 million beat.
Exactly. It's a 23.5% upside surprise. And, in corporate finance, you just don't see companies of this size miss the mark by that much unless something fundamental is shifted in the background. It's not a rounding error.
Right. It's a massive shift. But, okay, before anyone goes out and remortgages their house to buy shares, we need a massive reality check here. Because over the trailing 12 months, Opendoor brought in $4.7 billion in revenue. Huge top-line number, sure. But they are still carrying a $317 million net income loss over that same period.
Yeah, the red ink is definitely still there.
Right, and an EBITDA loss of $149 million. Which, for anyone not elbow deep in financial statements, EBITDA just means their earnings before we factor in things like interest, taxes, depreciation, and amortization. It's basically a way to look at the raw operating profitability of the core business. And their core business is $149 million in the red.
Right. And you don't just ignore a nine-figure hole in the bucket. $149 million is a lot of money to lose. But in a turnaround story, the trajectory of the bleeding matters way more than the absolute number at a frozen moment in time.
The trajectory. So you're saying it's about the trend line.
Exactly. Look at Q4 of 2025. Those adjusted EBITDA losses were significantly narrower compared to the $49 million deficit they posted in the same quarter the prior year. The bleeding is slowing down dramatically.
Because their unit economics are actually improving. I mean, they are turning over their housing inventory faster, right? Which means lower holding costs, which obviously frees up capital and expands their margins.
You nailed it. The market is looking at the angle of that line and projecting the exact month it crosses into the green. Because the faster you flip the inventory, the less you pay in, property taxes, insurance, and the massive interest on the debt you used to buy the house in the first place.
Right. Holding a house is incredibly expensive.
Extremely. And their CEO, Kazanajation, he's been executing this very rigid 3-point profitability plan. And his goal is absolute net income positivity by the end of 2026.
Which is coming up fast. Let me put this in perspective for you, the listener, because when I think of Opendoor's old business model, like before this big turnaround, I always picture a clumsy, over-leveraged house flipper.
Oh, that's a great way to put it.
Right. You know the guy. He borrows way too much money to buy a house, and then the market shifts while he's, putting in the new kitchen cabinets, and suddenly he's caught holding the bag, paying massive interest on a property he literally can't sell.
Yep, the classic flipper trap.
Exactly. So my pushback here is, if Opendoor is still losing hundreds of millions a year, why is Wall Street treating a slightly narrower loss like they just won the Super Bowl? Did they fundamentally change how they do business, or did they just have a lucky quarter with some fast sales?
It's the former. They are being rewarded for surviving the iBuying graveyard, essentially, and for fundamentally rewiring how they operate so they never become that clumsy house flipper again.
The iBuying graveyard. That is quite a phrase. I mean, we're talking about Zillow offers, Redfin now.
Yeah, exactly. Those were massive, incredibly well-funded corporate giants. They tried to use algorithms to just buy and sell homes at scale. And they got absolutely annihilated.
Annihilated because an algorithm is only as good as the market conditions it actually understands.
Right. And in 2022 and 2023, the algorithms failed spectacularly. I mean, they just kept aggressively buying homes at peak prices right as the Federal Reserve started jacking up interest rates.
It's the worst possible timing.
Oh, the worst. Mortgage rates spiked, buyer demand just evaporated overnight, and these companies were left holding billions of dollars in rapidly depreciating real estate. Zillow took catastrophic losses. They exited the space entirely. Redfin scaled way back.
What Opendoor took massive hits too, right?
They did,
Right.
but they survived. And by simply being the last major player standing, they became the undisputed leader in iBuying.
Wow, so it's basically a competitive moat built out of the ashes of their rivals. And because they've processed billions of dollars in real estate transactions over the years, their proprietary algorithm is now trained on real-world survival data, like down to the neighborhood level. They have a massive pricing intelligence advantage.
Exactly. Which brings us to the actual operational shift. Because the old model, like we said, was highly capital intensive. You use massive balance sheet leverage, basically corporate debt, to buy a house outright, hold it, and just hope to sell it for a profit.
The holding period.
Right. The holding period is where all the radioactive risk lives. So to eliminate that risk, they rolled out a program called Cash Plus.
Ah, Cash Plus. Okay, this is the part of the new business model that changes the math completely. Because instead of using millions of their own dollars to buy a house, Cash Plus shifts them into more of a highly efficient, data-driven matchmaking service.
Yeah, exactly. Matchmaking is the perfect word for it. They are facilitating the transaction between a seller who wants speed and certainty and a buyer who wants a specific property. Opendoor locks in the buyer and the seller, essentially clearing the transaction simultaneously.
So they never actually own the house.
Well, they capture a transaction fee or a spread in the middle, generating revenue without ever taking the property onto their own balance sheet for a prolonged period.
That is brilliant. So they get the upside of the transaction volume without the massive risk of holding the inventory. They are monetizing their network of buyers and sellers without tying up billions in physical houses. And you can see the results in their short-term solvency.
You really can. The numbers back it up.
Yeah, because they currently boast a current ratio of 7.0x, meaning they have 7 times more liquid assets on hand than short-term liabilities. That gives them immense breathing room.
Breathing room that allowed them to reach an enterprise value of $3 billion and a price-to-book ratio of 4.74x.
And for context, price-to-book compares the market's valuation of the company to the actual net value of its physical assets if it were liquidated today. So trading at nearly 5 times their book value, that shows the market is valuing their algorithm, their network, and their future earnings power, not just the physical houses they happen to own.
Exactly. It's a tech valuation, not a real estate holding valuation. And the ultimate proof of concept came in Q2 of 2025. That's when they generated over $2.1 billion in positive operating cash flow in a single quarter.
Hold on, $2.1 billion in 1 quarter.
In a single quarter. It proved that when transaction velocity increases, this leaner matchmaking model can generate massive amounts of cash. It completely invalidated the old narrative that iBuying was fundamentally just a cash incinerator.
That is a staggering number. But, a stock doesn't jump 340% just because a few analysts notice better cash flow.
Right. We are looking at a serious clash here between a retail hype machine and major institutional validation.
Oh, absolutely. The price action has been explosive. I mean, after that Q4 earnings beat in late February, the stock surged. Then early March brought a consolidation phase. You saw the stock slide a bit on March 2nd, 3rd, and 12th.
Yeah, I remember looking at the chart then. But if you look at the broader market data, those pullbacks were driven by macro real estate headwinds, right? The sector pressure, not company-specific bad news. Exactly. Investors were just taking profits after a massive run. They were establishing a higher low before the next leg up. Healthy consolidation is vital in a run like this. While retail investors are riding the momentum, the institutions are completely re-rating the stock's fundamental value.
Right, like UBS.
Yes, UBS drastically raised its price target from $1.60 to $5.
That's a 212% increase.
Yeah. That is a major institutional bank looking at the new unit economics and publicly admitting the thesis has changed.
Okay, institutional validation is a powerful catalyst. But I mean, $5 looks incredibly conservative next to Eric Jackson. He's the hedge fund manager we mentioned earlier who set an $82 price target for 2028.
The infamous $82 target.
Yeah, and he recently went on the record arguing that $82 might actually be too conservative because under Kaz Najation's leadership, Opendoor's acquisition pace has accelerated 3.4 times. They are growing much faster than the market realizes.
Okay, but we have to separate the mechanics from the mania here. An $82 target implies a 1,540% gain from current levels.
Right.
For a company that is not even profitable yet. And we know retail traders, groups like Wall Street Bets, they've been all over this ticker recently. That adds a ton of volatility.
Which is exactly why I want to push back on this. Because how much of this $82 target is actual mathematical positioning and how much is just, throwing gasoline on a speculative fire? I mean, 1,500%, come on.
It sounds wild. But Jackson's target is what we classify as a terminal bull case. He isn't trading the current fundamentals. He is trading a future where Opendoor achieves monopoly-like dominance in algorithmic real estate. He's picturing them capturing a massive percentage of all U.S. housing transactions.
Assuming a frictionless future.
Exactly. He assumes a frictionless future.
Which is a monumental assumption. I mean, the retail crowd is trading the short-term momentum. The smart money, like UBS moving to $5, is trading the mathematical reality of narrowing EBITDA losses. But Jackson is looking 5 steps ahead. And if they're going to reach $82 or even stabilize in the $15 to $20 range, they have to survive a brutal obstacle course.
Which is why the overall market sentiment remains bullish with healthy skepticism. The bullishness is based on the data, but the skepticism is based on execution. If they don't execute this transition perfectly, that 540% upside just evaporates.
Yeah, so let's talk about those obstacles, because perfection is not exactly Opendoor's historical strong suit. The biggest internal risk is obviously execution delay. They promise the market absolute profitability by the end of 2026. If they miss that timeline, the patience underpinning this 340% rally vanishes overnight.
Oh, completely. You only have to look back at their 2022 performance to see how quickly things can unravel. If Q1 or Q2 earnings drop this year and the unit economics start deteriorating, like if they revert to overpaying for homes or holding inventory too long, institutional investors will dump the stock.
Just walk away entirely. Though, to be fair, the market is pricing in some of that risk. That price-to-book ratio of 4.74x we talked about, it's high, but it's not pricing them as an invincible tech monopoly yet. But I think the bigger issue, the risk they absolutely cannot control, is the macro environment.
Yes. Persistent high interest rates or a broader economic recession. If mortgage rates climb and housing demand weakens across the board, transaction volumes just dry up.
It's like they spent the last 2 years completely rebuilding the engine on their sports car.
Right.
And it runs beautifully now, but it doesn't matter how well the engine runs if the actual road they are driving on, the macro economy and the housing market, is completely washed out. Are they still entirely at the mercy of the Federal Reserve?
Well, they're definitely impacted by the Fed, but they are no longer at their mercy. And that is the absolute genius of the cash plus model. In the old days, a drop in volume meant death because the holding costs of their massive inventory would literally bankrupt them.
Because they owned all those houses.
Exactly.
Yeah.
But today, because they're acting more like a matchmaking marketplace with drastically lower holding costs, they can survive on significantly lower volume. Their margins per transaction are vastly improved. So the washed out road slows them down, sure, but it doesn't total the car anymore.
Okay, that makes a lot of sense. So if you're looking at this 340% run-up and wondering if the engine's going to hold together on that bumpy road, what are the actual milestones you should watch over the next few months?
The immediate catalyst is late April 2026, when Q1 earnings drop. The market needs mathematical confirmation that the massive Q4 beat wasn't just a fluke. They need to prove that inventory turnover is still accelerating.
And then, as we move through Q2 and Q3, the march toward the profitability milestone continues. And the math shows that if they cross into net positive territory, it could trigger a massive institutional re-rating. And this is huge, a massive short squeeze.
The short squeeze mechanics here are fascinating. When investors short a stock, they borrow shares and sell them, hoping the price drops so they can buy them back cheaper later. If Opendoor proves they are profitable, the stock price will spike.
Yeah, imagine a crowded theater where someone yells, "Fire!" But the only way out of the building is to buy a ticket at the door. That is a short squeeze. The bears who bet against Opendoor are suddenly trapped. As the price rockets up, they are forced to buy the stock at any price just to cover their losing positions.
which drives the price even higher.
Exactly, creating a vicious upward cycle.
And alongside that internal profitability trigger, you have external catalysts too, like confirmed rate cuts from the Federal Reserve. That would instantly lower mortgage rates, stimulating housing demand, and acting as a massive tailwind for transaction volumes.
We also have to factor in the wild cards, right? Speculative catalysts. If that Cash Plus program scales faster than anticipated, profitability arrives ahead of schedule. And then there is the persistent chatter about mergers and acquisitions.
Oh, the M&A angle is huge. As a platform like this gets closer to proving its algorithmic model actually works at scale, it becomes an incredibly attractive asset for larger financial institutions.
So when you aggregate all these catalysts, the risks, and the financial health, the underlying math gives Opendoor an 8.5 out of 10 bullish score. It's a high conviction setup. But the strategy to trade it requires iron discipline. The recommendation is to treat Opendoor as a 12 to 24-month multi-year hold. You build a 60% core position on strength and keep 40% of your allocated capital on the sidelines to tactically add during 10 to 15% pullbacks.
Because the volatility is practically guaranteed, it might consolidate in the $4 to $8 range near term, while maintaining the potential to jump to $15 or $25 in the medium term as profitability hits.
But how do you survive that kind of turbulence without getting shaken out? Like on a random Tuesday when the stock just drops 8%.
You anchor completely to the data, not the daily ticker price. You don't sell on a red day. You sell if the Q1 earnings show that inventory turnover is slowing down.
Yeah.
You buy the dips if the dip is caused by broad market headwinds, knowing the core unit economics are still intact. You just have to divorce the violent volatility of the stock price from the actual operational performance of the company.
Makes total sense. So stepping back, what we are witnessing is a narrative of brutal evolution. Opendoor isn't just a lucky survivor of the great iBuying crash. They used that existential crisis to completely rewire their corporate DNA. They leaned heavily into their proprietary data moat. They shifted away from debt-heavy balance sheet risks with capital-efficient programs like Cash Plus, and they are now tantalizingly close to proving that an algorithmic, friction-free home buying model can actually turn a profit.
And crossing that profitability line changes the entire landscape, which leaves us with a fascinating dynamic to consider. We talked about Eric Jackson's $82 price target and the assumption of total market dominance. But think about the broader financial ecosystem for a second. If Opendoor truly cracks the code on profitable algorithmic real estate by the end of 2026, they don't just become a highly successful housing company.
Right, they become the ultimate acquisition target.
Exactly. Imagine a legacy bank or a massive Wall Street fintech giant looking to instantly own the liquidity of the U.S. housing market. They could just buy Opendoor and plug that proven algorithm directly into their existing multi-billion-dollar mortgage infrastructure. The synergy is terrifyingly efficient. So the real question isn't whether Opendoor can reach profitability. It's this: will they manage to stay independent long enough to ever hit that $82 target? Or will they be swallowed whole by a bigger fish right as they cross the finish line?